G'day taxpayers. Well, the dust is settling somewhat from the RBA decision to hold rates yesterday. I had a chance to look at the RBA Governor's press conference yesterday afternoon and a bit of commentary that's gone on since then. And I think it's fair to say that the RBA's shuffling around the goalpost a little bit with its planning, and having considered a 50-point cut in May, it did nothing clearly yesterday. So, a couple of things to note. The 2.9% trimmed mean inflation rate that the Governor mentioned a couple of times in her press conference is really a rookie error in my view, because we know that the year-over-year increase in any economic indicator includes data that's 6, 7, 8, 9, 10, 11, 12 months old. So that inflation number, the 2.9, includes the little bit of a spike in inflation that we saw in April, May and June 2024, July, August and September 2024, both which were a little bit higher, and sort of underplays the fact that in the last two quarters we've had a 0.5% increase in the trimmed mean, a 0.7, annualised those are at 2.5, and downplaying the monthly CPI, which again is another, I don't know, she didn't like the information, so we'll ignore it. But then on the other hand, she said, well, there's a couple of issues there that we saw in the monthly numbers that caused us to have some concern about a rebound in inflation. So take that whichever way you want. But the underlying inflation rate on the monthly numbers in the year to May is 2.4%, 2.5%. So it's in the target band. So it's a really curious thing. And the tight labour market, I'm not so sure, because wages growth is comfortably under control. So the wage price index running at 3.4%, so that's fine. The NAB survey came out yesterday with employment and labour cost expectations. They're fine, they're in the groove, so there's nothing to really say that the labour market's tight, because if the labour market was tight, wages growth would be lifting. And I also note the thing that's been covered extensively elsewhere is that a lot of the increase in employment, the resilience in the labour market, is all public sector driven, and that's the government meeting its social obligations to have nurses in aged care facilities, other education, health and NDIS employment, which is great. So we're looking after society, which is a good thing. However, that's all coming to an end. The nurses have all been employed in the aged care facilities. So I think public sector employment is going to slow markedly over the course of the next year. And unless the private sector, the sector that's sensitive to interest rates, starts getting on its bike and hiring more people, that unemployment rate will increase. So it's playing with fire on that score alone. And just by the way, I note that interest rates are still very, very high. It's only been in the last 2 years, out of the last 13, where interest rates have been higher. If we go back to that period from around about 2013 to 2020, just prior to the pandemic, interest rates averaged about 2%. So 3.85 is restrictive, and the RBA acknowledged that as well. So in the end, the RBA risks are that we'll see an extended period of very weak economic growth, that the disappointment from interest rates being very, very oppressive will be evident, I think, in upcoming consumer sentiment and spending numbers, putting downside risks. And already the risk is that with inflation falling so sharply, it won't take much for inflation to overshoot on the downside, getting inflation entrenched below 2.5%, which again is just as bad as inflation being above target. So, look, the RBA's made its decision, but I think it's made its decision on poor analysis, cherry picking the data that it wants to. So it clearly has a predisposition not to cut interest rates, and it was floundering around, sort of scrounging through the compost heap looking for little bits of information that would support its case to keep rates on hold. So we'll see what happens from here. All good fun though.